The warehouse where everyone gets a bargain. Or are you getting ripped off right now by the company as they down spiral all the way down to oblivion? Is the end of warehouse near, or can they turn it around and save you for this New Zealand stock that you may be invested in? Because they've gone crash and burn, 40% down on the year, and it could get worse as the recession hits. Is there a way for the warehouse to turn it around, or are they going to be one of the companies that go bust in 2024 and beyond, when a possible, more than likely, recession is already here? Well, welcome to the channel, Barry Charles. We're going to do a stock analysis on the Warehouse Group Limited. It's a New Zealand stock on the new NZX stock exchange. If you want to know more about it, just leave a comment and I can explain more to you if you want to invest into this company. But let's get to it right here, right now. We're going to do a stock analysis. We're going to look at the revenue. We're going to look at net profit. We're going to look at the PE ratio. We're going to look at the return on invested capital, shares outstanding, everything in between. And right at the end of the video, I will give you a possible intrinsic value, which to me sounds a bit silly on what I've seen on the metrics of this grams calculator that I use. But I just want to give you an opportunity to understand a little bit more about finances, and this is the Warehouse Group stock analysis and intrinsic value video just for you. Let's get to it. Let's start with the revenue. Yes, the revenue is at $3.2 billion. So they are still doing some decent revenue, but the net profit is down to 89 million. So it's starting to creep down to the bottom. The earnings per share is okay at 0.26. PE ratio of 6.7, so the growth is dead. This company is out the door maybe. That's what the metrics are telling you right here, right now. For all you Foot Locker fans out there, this is a similar stock that done the same thing. They cut the dividend. Boom, that's where the stock price fell. That's the main reason that it fell. Wasn't the only reason. It fell on bad news of their reporting that they're slowing down growth and all that. So this is so far not a good sign to get into the company. The market cap is not looking the greatest as well. And they're really dropping down, even though they got all that revenue in that game, but it's $600 million market cap. So yeah, not looking good there. The week range from $1.62 to $3.40, so it's very much in the lower range. It could go lower than that from time of recording, depending on if we see a turnaround. Assets versus the liabilities of Warehouse. Well, this is okay. $1.86 billion in assets, and the liabilities is total liabilities is $1.4 billion. So they have more assets and liabilities, but it's not a great gap and not like what I like to see, which I like to see a 3x difference between the assets and liabilities, which only a few companies do, but to me, it's not great. Free cash flow, negative cash flow of 6.5 million. It's not looking good, folks. And then the long-term debt's not too bad, 116 million. Long-term debt's not so bad, but still, when you're on a free cash flow of minus 6.5 million, you're going to take a long time to pay it off or never pay it off. So that's the query. They got to get their free cash moving forward if they want to continue to be a good company. Shares outstanding around 600 million. I'm pretty sure their market cap's wrong, but anyway, we'll continue on. Returning on invested capital was 6%, which is okay for a New Zealand company, to be honest. But is it really going to build your wealth to the end of the day? Well, this stock, a lot of people were in this stock to obviously get that sweet dividend, but they've cut that. So is there positive? Can the warehouse turn it around in 2024? The answer is I don't think so. I think we're going to see it just decline. But always the positive with the warehouse and most of these retail stocks, regardless of anything else, and maybe this next 3 months, is people will still buy stuff for Christmas. So the warehouse will get a rally at the end of the season. Most of the, Target, all these companies will get a rally at the end of the season. But after that, I think you're going to see catastrophic failure for these companies, and some of them will go out of business. And this is one stock in the and the chances are going there. Same with Foot Locker and a few other stocks. I'm not saying they're going to, but there is a risk, a potential risk that they could fall over, collapse, and be gone forever if they don't get this right. If we go into a big downturn and they do not get more money generated. They're not at net loss yet, so probably are safe. But if your net profit's more not enough for your long-term debt, so it's a bit of an issue going on with this company needing to move forward. Well, this is what we're here for. We're going to look at an intrinsic value of this company. Well, I got a bit of shock when I did this analysis, to be honest, but I do not agree with the figures that come up. But hey, this is not financial advice. Do your own research before you invest into any company. Invest at your own risk. But let's have a look at possible intrinsic value. I use a grams calculator. This is just a simple calculator. This is not complex at all. This is just a simple calculator. Then I take off a bit of dividend if they have a dividend in the company and other metrics to get my own intrinsic value. But this is just a simple calculator that just simply starts you on your way to understand a little bit about intrinsic value. So the warehouse, I'm going to say the share price is $1.70. It could be up and down from time of recording. Earnings per share is 0.26. And the growth rate, we'll say a small 5%. The intrinsic value of this company right now is $5. Wow. I was not expecting that one. If we keep the same metrics and have 10% on the growth rate, you're looking at 7.7. Now, I haven't got any insane number because there won't be an insane number with this company. If the earnings per share go up a little bit to 0.32 with the same growth rate of 10%, you're looking at 9.5. And then if we go up to 0.4 at 15% growth rate, well, earnings per share 0.4, we're looking at a stock that's nearly the $12 mark. So, where do I see the warehouse? Right here, right now, in terms of where I think the stock is valued? Well, growth rate is not expected to be great, even if they do turn it around. So I'm gonna say right here, right now, the stock intrinsic value to me is probably about 2.5, in my personal opinion. So I think there is a bargain here to be had. So anything under $1.50 is where I'd suggest buying into, but I think you'll be fine buying at this if it's not going to go bankrupt. Clearly, it can go bankrupt. I'm not going to say it's not because there's a possibility it can. Stocks that have been great in the past don't mean they're going to stay here forever. They need to turn it around, and they need to be quick and smart and turn it around the warehouse to get this going. But yeah, it's definitely a value play if they turn it around. If they don't turn it around, then look out. You could be into a value trap. So that's the risk you take with the stock. It's not a smooth transition, but it is a possible bargain opportunity, not financial advice. Do your own research before you invest into any stock. Invest at your own risk. Well, thank you. This was just a little bit about the warehouse stock, giving you a bit of analysis of the companies, where the metrics are at the moment and what needs to be done. Clearly, the warehouse group have to find ways back to more profitability and more sales. So they need to provide the products that the consumer wants. That is where the warehouse needs to go to, because in New Zealand anyway, the likes of Kmart are starting to take over their market share, and other companies are coming along. Even the likes of the Chemist Warehouse as well have taken over some of that when they were trying to do a bit of pharmacy stuff. So they're sort of losing their market share, the warehouse. So they're going to have to turn it around if they want to be in business long term. So that's a question mark for them. But anyway, thank you for joining me here, Barry Charles. Remember to like and subscribe to the channel, and I'll be back again 3 days a week to give you more of the stuff you love around finance. Have a great day out there.